Okay, so we've got another exercise here, and by now we have looked at a few examples where we deal with the accounting equation. And, there are several performance measurements that are used in accounting and finance. Return on investment, or ROI, is one. It's not a very good one, but it's one. We can look at return on assets, and we can also look at return on equity. Okay, so what is our return on our own equity? And I would invite you to read up a little bit on the concept of return on equity. I don't have time to get into it right now, but it's a very, very useful performance measure. In fact, Warren Buffett, a very wealthy investor, uses return on equity, or ROE, whenever he assesses the investment possibilities into other companies. So if it's good enough for him, it's probably good enough for us. All right. So we have a scenario here, and they want us to do a couple of things. They want us to calculate the return on equity ratio, which is going to be a percentage for the year. And I will tell you that we want that figure to be as high as possible. Now, it's whatever it is, okay? But if we had a choice between having a return on equity of 10% or a return on equity of 15%, well, our equity doesn't really change. I mean, it is what it is. We can't do anything about it. So, how much money did we make on that equity is valuable information. Okay, so we want that figure, we want this percentage to be as high as it can possibly be. And then the second requirement says calculate the debt to equity ratio as of December the 31st. So we know that the accounting equation is assets equal liabilities plus equity. So under normal circumstances, it would be fair to say, and we had some exercises like this already, but assets are going to be the biggest part. These two items here will add up to what assets are, and that's always going to be true. But under normal circumstances, both of these figures would be positive numbers. Okay, so if both of these figures are positives, what we would say is we want this figure here, equity, to be as high as possible and liabilities to be as low as possible. So the higher this number is here, the higher this debt to equity ratio is, well, that's not good. We want this number that we're going to plot here to be very, very low. If we can get it lower than 1, heck, that's great. Usually that's not the case, though. Okay, because that can indicate some other things are going on that we're not doing. So let's just take a look at this and see if we can figure this out. Now this question uses the euro currency. Don't get wrapped up in that. We don't have to write down any financial numbers and all, and even if we did, it wouldn't change anything. So it says here, at the end of 2017, let's see here, I guess that's Daimler AG, reported stockholders' equity of $64,023 million and total assets of $255,605 million. Its stockholders' equity at the end of 2016 was $57,950. Okay, and then further information. Net income in 2017 was $10,525,000. And again, that is in millions. So, how do we then calculate return on equity? Okay, so what we're going to do is we're going to set up a little formula down here There's a reason why I'm using a large version of the calculator. So return on equity is net income divided by average equity. So what we have to do is we have to take the beginning equity of 57,950. This was the equity on like the very first day of 2017, last day of 2016, first day of 2017, and then we also have to take the ending equity of 64,023, and we have to get an average on those, okay? Because we didn't have that 64,023. We didn't have that for the whole year. That was just our ending. So we find the midpoint between these two numbers right here. Okay, so let's do that. Let's take our beginning equity or ending at the end of 2016, 57,950. Okay, and I want to add to that our ending equity for 2017, 64,023, and that's going to give me 121,973. And then I'm going to divide by 2, okay, because I had two numbers in there, and I want to find the average of 64,23 plus 57,950. What is the average of those? And we come up with 60,986.5, and this again is in millions. And what I'm going to do is I'm going to copy the reason for that, okay? So my average equity was 60, let's see here now. I forgot what it was. Give me a second. 60,986.5. Okay. And then our net income for 2017, well, they just give us that. So that's 10,525. All right. So I'm going to clear this and I'm going to type in my net income of 10,525. And I'm going to divide by, and then I'm going to hit Control V to get my first figure back in there, 60,986.5. And then I'm going to hit equals. Now, this is a percentage because it's 0.17, and they say round answers to one decimal place. So it's going to be 17 point, and then let's see here. It's going to round slightly up to 17.3%. Okay, 17.3%. This is a fairly decent number for return on equity. And again, we want this number, I'm just going to put this here, we want this number to be as high as possible. Okay, I'm also going to put the letter A here so I can remember what I was doing. Now I'm going to clear out my calculator, and they want to know, they say calculate debt to equity ratio. Okay, well, let's go right here, put the letter B. All right, well, debt, let's see here, debt is synonymous with liabilities. Move that down just a bit so you can see that, okay? So what we're saying is, what is our ratio? When we talk about the debt to equity ratio, what we're asking is, what is the ratio of our liabilities to stockholders' equity? Okay, so let's look at our question. and by the way, let's see here. It says as of December 31st, 2017. So if we want to know the answer to this, let's set up another little, I'm going to put DTE, and that stands for debt to equity ratio, okay? And I'm going to put a little line right here, and I'm going to put liabilities over equity. Now, both of these items, all of the items in the accounting equation are balance sheet items, right? So when we think about what is a balance sheet, it is a snapshot of a company's assets, liabilities, and equity at a point in time, at any point in time. And that's different from the income statement. Our point in time just so happens to be December the 31st, 2017. So what we have to do, we know, because they tell us up here, that our equity at the end of 2017, and it doesn't get any more ending than December 31st, our equity is 64,023. So we know what that figure is. So we're going to write it right there. However, I do not see any information explicitly given to us in the question about what liabilities are. So we have to figure out what liabilities are. How do we do that? Well, it says right here that assets are 255. And if we apply that logic to the accounting equation, we know that 255,605 goes here. And we know that 64,023 goes here. So it's just the difference between those two figures. So let's figure out what it is. 255,605 in assets. And I'm just going to subtract out my equity of 64,023 to come up with 191,582. Okay? And then, because I'm just dividing it by equity, I already have my numerator right here on the calculator. I can just simply divide by this figure right here, our equity figure at the end of the year, and we come up with 2.99. And let's see here, they only wanted 1 decimal point, so our debt to equity ratio is a 3. And I would tell you that that's probably a little bit, that's reasonable. We could probably stand for it to be a little bit lower. This is a number that we want to be as low as possible. Okay, so that's all those arrows mean, is that ideally we want return on equity to be as high as we can get it, and debt to equity ratio, with some exceptions, to be as low as we can get it. All right, so that's our exercise on the accounting equation, return on equity, and debt to equity ratios.